we can see here that this policy was designed specifically for him to use it as a savings vehicle on top of all of the other benefits that come with just simply having a life insurance policy. So he's killing a lot of birds with just a few stones, if you will.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
Welcome back to another episode of Well Positioned. This is your host, Kyrie Graves, back with another video. And in this video, we're going to talk about three reasons, right? Three reasons why rich people love whole life insurance. When I say rich people, I mean people that are already wealthy or in the process of building wealth and just have a rich mindset, right? People like myself who are thinking ahead. And one of the products that I came by that just kind of became like a no-brainer was whole life insurance. And it's one of the main reasons why I even became a life insurance agent, because I just fell in love with this product so much. And I really want to, help people obtain a properly designed whole life policy. Like that is something I get really excited about. Anytime I have a client that acquires one of these policies, like I just feel so good. I feel like I really did something to help that person for the rest of their life. You know what I mean? It's a really cool feeling, and hopefully, for those who are looking at this video, maybe I'll be able to help you out, one day. But in this video, I'm going to provide three reasons, right? Three reasons why whole life insurance is loved by people that are trying to build wealth, wealthy people, rich people. And what I'm going to do is I'm actually going to pull up a policy illustration. It's something that I designed, through a system that I have access to. And we're going to look at, a few things. There's a lot of information in it, but there's a few things that I want to pinpoint that may hopefully open your eyes to possibly looking at a product like this to fit into your overall financial strategy and financial plan, because this is not financial advice. I want to give that disclaimer. But one thing I found is that people look at all the different financial products across the board and they often think, oh, should I do this one or this one? And I'm in the camp that says I think you should do this and this, right? You don't have to necessarily choose one or the other. There's ways you can and reasons why you can use different products set up differently, throughout your life to do different things that gives you an overall, portfolio that's going to perform the most optimally. And that's what the book is about. That's what One Small Tweak is really about. It's taking, some of these well-known products that we use, the 401ks, retirement funds, savings vehicles, and putting it all together and saying, okay, how can I tweak each of these products to do exactly what I needed to do? And it gives you a foundational understanding of exactly how to do that. So I encourage you to pick up the book, educate yourself on what a foundational, investment and savings setup really looks like. And then from there, you keep building up your knowledge, educating yourself, and then you can start making one small tweaks and adjustments to that portfolio that is going to give you even more and more of an edge to build your wealth. That's what I'm here to do, help you build your wealth. So without further ado, we are going to look at this, insurance policy illustration that I put together real quick. And I want to just give you three things, and then I'm going to let you go. Three reasons why we're going to use this puppy to build or help us build wealth over the long term. So let me share my screen here. All right, so I hope you can see my screen okay. So what we're looking at here is a insurance policy illustration that was, designed by me. And this is purely an example of what a, 40-year-old male, with $30,000 to put into a policy. This is basically a breakdown of what his policy would look like over the long term. So we can see here that this policy was designed specifically for him to use it as a savings vehicle on top of all of the other benefits that come with just simply having a life insurance policy. So he's killing a lot of birds with just a few stones, if you will. But one of the things, one of the things I want to touch on is the reason number one. Reason number one of why rich people love products like this is because he's going to put his $30,000 in every year, and with the rest of his money that he wants to take some risk with, he's going to be able to do it very confidently. And that's what this policy is offering him. It's offering him a peace of mind that is giving him predictable rate of return over the long term. And it's going to not only benefit him now if he needs to tap into the policy to use some of that liquidity, but it's going to benefit him so much more in the future if he allows it to continue to mature and mature and mature. And that's the main thing with these policies, is this is not a short-term product. This is for your entire life, your whole life, right? So that's reason number one. Allows him to take risks in other areas. Let's look at reason number two. Reason number two is, we're looking at this column here. This is my favorite column. This is the cash value column. This is the amount of money that this individual is going to have over time, right? He's going to have this money in his cash value that he can access at any time. If he wants to borrow from it, withdraw it, whatever he wants to do, he is going to be able to do that. And that's the beauty of this policy. If he goes to the bank and he wants to borrow money or take out a loan for any reason, whether it's a mortgage or a car or things like that, and they say, sir, how much cash liquidity do you have on hand? He can pull up his whole life insurance policy and say, hey, I have $170,000 in cash value sitting in a life insurance policy, and I got another 40,000 sitting in the bank. So, this guy's sitting pretty good. He's got enough liquidity to make some moves. But see, the difference is the money that's sitting in this insurance policy, it's maturing and it's starting to build itself up. And, one of the things I wanted to highlight was this internal rate of return column that we see here. And we see that, yes, in the beginning, you're going to, one of the main things that these policies try to do is remove all of the risk that the insurance company is taking on us or on you as the policyholder. They want to remove that risk as early as possible in the policy. So any fees and mortality rates that come into play that make the first few years of the policy very risky for them, because if you die, early on in the policy, they got to pay this death benefit out. This death benefit is quite large. So to kind of offset that risk, they're going to kind of keep a little bit of cash value that you're putting in the beginning. And after a few years, they slowly start to back off, right? And what we're seeing here is that, this internal rate of return, what this is saying is that, if we look at an arbitrary age, like age 60, right? At age 60, we see 3.59% internal rate of return. What this simply means is that the policy has returned 3.59% every year since age 60. So this is retroactively calculated. I hope that makes sense, and I hope I didn't lose you there. So that is reason number two. Asset on your balance sheet. This is your money. You will not be penalized for tapping into this cash value. Insurance companies encourage you to use your cash value to do, things that you want to do in life, but you never want to pull from it, all the way to where the policy can lapse and things like that. You want to be strategic about how you're using this. Maybe the market dips 50%, right? Stocks fall 50%. You say, okay, I want to borrow $100,000 from my whole life insurance policy. I'm going to buy the dip, and next year I'm going to pay myself back, or pay the insurance or that borrowed money back to the insurance policy so it can get to where it once was. And that's some of the cool things that, wealthy people do. They take advantage of, economic downturns and recessions and, market crashes. They take advantage of it with policies like this that are designed like this, that has that savings component that is just working in the background. And the thing about these policies, they're guaranteed to never lose money. You will never lose a dime in these policies, right? I often say that a whole life policy is not an investment. A whole life policy is not an investment. A whole life policy is an asset. The investments come with risk. This does not. And that's the beauty. That's why rich people love whole life. Reason number three why rich people love whole life insurance. And this is the last thing I'm going to go over. See, rich people understand something very fundamental. What they understand is that planting a seed in your early years while you're working, into the right soil that will yield a great return later in life. That's some of the best fundamental ways to go about life. You should always be looking for, okay, what can I put, resources or money into now while I have energy and I have a lot of drive and stamina to go about life and to add value to the world and in exchange, bring in resources. Where can I put some of my excess, savings, my excess money? Where can I put that so that later in life it's going to blossom into a harvest, into something that is going to pay even greater dividends than what I put into it, right? Tap into the mindset with me, if you will, right? Finding those assets that do that, right? Stocks certainly do that, but stocks come with a lot of risk, right? And just saving in some cash, can do that. It gives you a cushion, but there's no return, right? So you need a vehicle that's going to, allow you to put money into where I say, okay, I put an X amount, but when I'm ready to pull from that, I have, way more. This policy here, I'm going to show you exactly how this policy is able to do something like that. So let's take a look at our 40-year-old male, for example, right? So this guy chose to only fund this policy by $30,000 a year for the course of 15 years. That's all he wanted to do. He just wanted to get a nice foundational, nest egg going that's going to grow. So he said, okay, that's all I want to do, $30,000 a year for 15 years, and then I'm done. And I don't plan to touch this until I retire. That was his plan. That's the plan that, I obviously made it up, but that's the plan that me and this gentleman came up with when I sat down with him and we were talking about how to come up with the best whole life policy for him. So what we're looking at is he funded it for $30,000 a year for 15 years. That cost him $450,000 over the course of 15 years. So a little bit less than $500,000 over the course of 15 years that he's put into this policy. And he says, I'm going to let it mature for a few more years. And then when I turn 66, I want to take my $30,000 per year back out of the policy. And he was curious, how many years can I get out of that, right? How many $30,000 pulls, will I be able to do? So he put in 450,000. Let's see how long and how much, he was able to take from this policy, in the retirement in the later years of his life, right? He planted this $450,000 seed. Now let's see what it blossomed into. So now we're looking at right after his first year of retirement. So age 66, he starts his $30,000 pull. He wants to start putting that money back into his pocket, right? Pretty cool. And we're seeing that, man, he's able to do this not for 15 years. He's able to do this from age 66 all the way until age 100. That's incredible. I mean, that's incredible. And he probably could have went a little bit more, but he didn't want to stretch the policy. He didn't want the death benefit to start thinning out. So, I mean, 100 years, if any of us live 100 years, that's a blessing, right? And this guy obviously is doing financially well in other areas if he's able to put in $30,000 a year into this savings vehicle that we're calling whole life insurance, right? So, man, let's take a look. So he put in $450,000 for 15 years, and now he's pulling out 30,000 a year from age 66 to 100, man. So, wow, he's already passed. Now he's getting close to 600,000, 750,000. So, wow. So over the course of 40 something years or 34 years, from age 66 to age 100, he's able to pull out over $1 million. That's pretty impressive. And not only that, he has a 1.4, $1.5 million death benefit in case he passes, before that he can leave to his children or leave to his family. So this guy is, I mean, he's set up pretty damn good, man. I'm proud of this guy for even, thinking ahead like that and planning his legacy out as early as age 40. And if you're fortunate enough to plan your legacy out even before age 40 or even a little bit after, then more praise to you because that's what this whole thing is about, right? Like we want to plant those seeds early, have them blossom, benefit from the yield that is, in this case, it's more than 2xing, right? It's more than doubling. And he has this death benefit still on the side that whenever he passes, and he still has a ton of cash value even after he pulls his, 30,000 after age 100, if he lives beyond that, still has a ton of money to pull from. And if he passes, he has a ton of money to give to his family. Like, man, that's the beauty of whole life, and that's why rich people love it, right? You can do so many different things with it, and it gives you that safety and protection in place. That's one of the reasons why I picked up, one of these whole life policies. The second I got my insurance license, I made sure I got one of these, and I designed it specifically for what Kyrie needs. And yeah, I encourage you to check this out and set yourself up perfect for the future. That's what this channel is about: being well positioned for the future. Setting yourself up, financially for your family and all that good stuff. So that's exciting. That's all I got for now. Thanks for listening. Thanks for tuning in. We'll be back.